thank you all for coming. Today, obviously, we're going to talk about Aquis Exchange PLC. But before we do that, we'll do some introductions. Jonathan, do you want to introduce yourself?
Jonathan Clelland. I joined the business at the start with Alasdair, and I am the CFO and COO. Oh, and company secretary in my spare time.
And I'm Alasdair Haynes, the founder of the business. I've been in the city for over 40 years. As I like to say, most of the people I started with are either dead now or made so much money I'm still here, which obviously is something about my character. I'm still love the city. So what is Aquis? We've got a presentation here, but actually, like all good things, we don't really want to go through much of that presentation. There's some things I'd like to dip into and certainly answer questions at any time during this talk. But I thought the best thing is to actually sort of explain a little bit about what does Aquis do and why are we different and why do we think we'll succeed. And the first thing I'll say is many of us came from Chi-X. My background was, as I said, 40 years in the city. I started a company called ITG, electronic broking business, and then ran Chi-X. We sold the company, $365 million. We had 21% market share across Europe. Was, he says, hopefully not arrogantly, but the most successful equities trading platform or exchange that's probably ever been launched in Europe. The nice thing is having sold the company, they decided that, or I decided I didn't want to stay with it, but they very kindly, the new owners, fired 85% of the staff, which we weren't expecting. So it was the greatest opportunity to put the band back together again with a new business model. And the business model, like all things in modern times, was created actually by my son, who was 13 at the time, who now takes credit and will probably try and take all the money from the business. But like all, if you have or know 13-year-old children, they only have one interest in life, and that is their mobile phone. And in buying him a mobile phone in Tunbridge Wells in Vodafone, he turned around and said, I want the all-singing, all-dancing latest iPhone. I turned around and went, well, hang on a second, that's unlimited data, unlimited texts, unlimited downloading. I sort of knew what he'd be downloading, and I didn't think his mother would be very impressed. I knew that he'd be talking to his mates all day and not doing much homework. And then suddenly twigged that actually this is an incredible business model. What is Vodafone actually doing? They're managing message traffic on a subscription. And I'd looked at what I'd been doing at Chi-X, and I was managing message traffic, but not on a subscription. And being the type of person that I was, I went back home, looked at all sorts of academic papers about subscription pricing, and was completely blown away. Now, looking around the table here, there's sort of from all different ages. What I would say is that I can't imagine any of you do not have subscriptions in your life today. Almost all of you will have Sky Television at home. Almost all of you will have a mobile phone based on a subscription. You and your family will download movies through Netflix. You will listen to music on Spotify. You may well shop on Amazon Prime. And subscriptions change people's behavior. And what will amaze you is we are the only company in the world in financial services that offers a subscription model. And when you look at what subscriptions have done to other businesses, how fast they have grown, they are the most, according to The Economist, the most successful businesses over the last 20 years have been based on the subscription model. And almost all of those companies have changed people's behavior. Movies today are made now for companies like Netflix. They don't, in Hollywood, the incumbent is very worried about this. If you look at Spotify, you could get $30 million of singles. That's what it would have cost you, $30 million 30 years ago, and you get it for $10 a month. Amazon Prime has 100 million Americans on Amazon Prime today who spend double. That's $1,400 a year they each spend. Those who are not on Prime spend $700. So if you want growth, and if you want to change behavior, and you look at the way you use your mobile phone today and the phone calls, then subscription model is the way to go forward. I scream at my kids today for many reasons. When I was young, I was screamed at by my parents, get off the phone now, it's not 6 o'clock, which will remind a lot of you that 6 o'clock used to be a lot more cheaper and was a lot cheaper. There I have a friend who lived abroad. He was an ex-friend very, very quickly because that was extremely expensive. And you obviously paid for the length of time you were on a call. So my parents were regularly saying, get off the phone now, you've been on there for 5 minutes. Of course, today you don't have any of that. And it's the same when it comes to equity trading. We have this great belief that one day all trading will be like this. In other words, this model is the model of the future. And that's what Aquis is based on. So the massive differentiator between us and anyone else is the introduction of a subscription to the industry. So our customers today pay on the message traffic they use. It is not on the traditional way that you have when you buy a stock or share on the London Stock Exchange. Today you buy one share of Glaxo and you pay the London Stock Exchange 10 times more than buying one share of Vodafone, simply because the cost on an ad valorem basis is Glaxo is 10 times more expensive than Vodafone. The cost to the exchange is exactly the same. The message on the message traffic says GSK or it says VOD. And therefore, when you think about how businesses operate, that doesn't make any sense if the cost is no different and yet you're being charged 10 times more. So, yeah.
In your business, what is the definition of message? Is that an order?
It's a great question. What it is, now there's two things we look at. First is a message, if it's passive, in other words, if you're supplying liquidity to the marketplace, we don't count that as a message, it's free. So you can become a market maker or a supplier of liquidity and you can trade on Aquis all day and it will cost you nothing. When you actually aggress, and so you're going to a marketplace and you want to take advantage of what is in the marketplace, then we actually start to charge you. And that is an order, it's a cancellation of an order, it's a correction of an order. It is actually when you use the network. And we're charging you for the use of a network. And exactly the same way, we copied what Vodafone had done, is if you use the network a very small amount, we charge you £2,000 a month, and it goes up in tiers right the way to £50,000 a month. And at £50,000 a month, you get unlimited downloads, unlimited text, unlimited calls. The same thing, you get unlimited messages, you get unlimited data, you get unlimited connectivity to us. So we started about 6 years ago on this project. And I can tell you, just after we launched, 5 and a bit years ago, we had the best-selling novel at the time at Christmas, I say novel because it's not actually true, it's actually a fact, was Flash Boys by Michael Lewis. I don't know how many around the table have read Flash Boys. It is a great book. And the sad thing when I started off by novel is when I first read it, I wanted it to be a novel. And now, years later, I can tell you that it is absolutely fact. What goes on there used to be, everybody said, was an America phenomenon. Actually happens in Europe too. We brought in a rule, not against a type of person who's trading, but against a type of order flow, which was if you are a proprietary trading firm and you're not acting on behalf of customers, you can become a member of Aquis, but you can only supply liquidity. You have to use a specific order type we invented called the post-only order type, which means you can supply liquidity, but you can never come to our market and cross the spread. And that order type specifically prevents you from ever doing that. Now, when we introduced this, we created the first ever protected marketplace from a type of trading. Now, we'd spoken to our board and said, at this time, we're likely to go backwards, spend some time, rebuild the business, and regrow again. It didn't do that at all. The volume traded, or the volume available in our market exploded. Because what happened is we created this safe haven for people to supply liquidity, knowing that they could not be aggressed by people who were arbitraging the marketplace.
Sorry, could you explain a little more about this order type? I didn't quite catch.
Okay, the post-only order type it's called post-only. So what happens is you can only post orders. So you are a market maker or you're a principal trader, you use this order type. If the price moves while you're trying to put the order in and would actually make you aggressive, in other words, the price, you're going down there trying to bid, but by the time you've gone down there, within the few microseconds, the offer's already gone there and you would trade and you'd be the aggressor, you get rejected. So at no point in time can you ever be an aggressor. It's impossible to aggress. Now, that means that these people are suppliers. And we have today a number of proprietary traders who supply significant liquidity to us. In fact, if you look, and we'll cover a couple of these slides in a minute, what you'll look in here is we're the second largest, in most markets, the second largest provider of liquidity with a market share of liquidity between 15 and 20%. of the entire marketplace.
So, sorry, the post-only order type can't be amended, can't be withdrawn?
It can be withdrawn, it can be changed, it can be cancelled and corrected, but it's only ever going to be posted. So what a lot of these people do is they arbitrage between exchanges. So if they see liquidity on one exchange, and they'll say, well, I'll take that liquidity, move the price very quickly, wait for somebody to come along who's a buyer, they'll identify the buyer, and then offer it at a higher price. Nothing illegal in what they're doing. What they do is they can come around to us, but they can't take this liquidity. They're not allowed to. And they get very angry about that because it's protected and they don't have the right to come in because our rule says you can't come and trade on our platform unless you supply liquidity. And that's made us. And the best way to look at this is what effect does this actually have? This is the UK market. I can give you this study for any of the 8 major markets in Europe where the study was done. And it was done by a third party called Liquid Metrics. And what they did is they literally took millions and millions of trades. Every single trade that got traded on a lit book and a dark book throughout a period of time was monitored. And monitored in such a way that the line x-axis here is time. And you can see the very first thing is 50 milliseconds, 200 milliseconds going right out to 5 minutes, and it's logarithmic. And what they're saying is that what happens to price over those periods of time on every single trade in the UK market. Now, I imagine all of you in this room trade. I imagine all of you have tried to buy stock and watch the stock move away from you when you bought the first few shares. And that is a real pain in the neck. And that is your cost of trading, is not the explicit costs of the actual fees that you pay or the commission you pay. It's the implicit costs that are killing your portfolio because as you're starting to trade, prices move away from you. And that effect is created because of signaling risk. As people see you start to make an order, prices move against you because people signal that. They can identify it with all this algorithmic trading that's taking place. You can see on Aquis, this is a measurement of price movement, a negative price movement against you. So what you can see, if you look at the yellow line, the blue line, the grey line, the light blue line, you'll see those are turquoise, London Stock Exchange, Chi-X book, the BATS books. Within 50 milliseconds, you can see an enormous movement, a very, very sharp movement. That's 1,000 times faster than you can blink. You can't see this on your screen. This is 1,000 times faster than you can blink. Price is moving against you. You can see very clearly with the blue line on Aquis here that prices don't move anything like the same. There is a fundamental difference between trades that take place on Aquis without this signaling risk than trades that take place on any other platform. And you should say, well, is that actually important to me? Well, the answer is yes, because if price was to move the minimum amount, and there is a minimum tick size set by MiFIDII, set by ESMA, so a stock can only move, if you look at the bare minimum, that value between the price you trade on Aquis and the price you trade on any other platform works out to be about £1 billion a year. So if people were to trade on Aquis, the end investor, that's you and me and the portfolios, save at least, at the bare minimum, 1 billion. You can start to see why aggressive proprietary trading firms like to take advantage when you look at the sums of money that are truly available here.
If it only took a change in your rules to open up volume, and if the benefits are so great, won't these other exchanges simply change their rules and therefore remove your advantage?
Absolutely the great question. And the answer to that is they can't because of the subscription model. When I operated Chi-X and I ran Chi-X, the vast majority of our revenue came from 7 to 8 proprietary trading firms. If you lose those 7 to 8 subscriptions, you lose 7 or 8 subscriptions. It's not a huge amount. I'm not losing 50+% of my revenue. It's very, very difficult on an ad valorem basis for somebody to cut out their biggest generators of income. And therefore, the skill or the cleverness of Aquis is you have a subscription model that operates with a very, very game-changing rule. And it's very hard for these firms to then now cut out the proprietary traders without a significant damage to their revenue stream.
But if that damage is happening, can't they employ the Disney strategy of taking you on at your own game?
They certainly can. And that's, if you think of the analogy between British Airways or any of the national airlines and the actual the Challenger Airlines, then the winner is the person who can supply at the cheapest price the most effective technology and is actually not encumbered with all sorts of legacy systems and higher costs. So if you end up with a war of attrition, then the winner will be the person who provides. Now, I used to say at Chi-X, and I would say the same thing here, we actually have less staff than the catering departments of the national exchanges. How can you go and compete if you can have efficiency at that level through your technology?
Okay, so what you're saying is that the incumbents can't compete because it's very difficult for them to throw away their existing business, but other new startups could do so quite easily. What would stop them?
Right, it's very, and it's a slightly arrogant answer, and I'll apologise in advance, but getting into the exchange industry, we had an incredibly lucky break. One of the things that happened to us with Chi-X is we were referred to Monopolies Commission. Nobody would ever tell you that that's a lucky break. However, during that period of time, we had a 21% market share, and our person who was buying us had a 4% market share. But they had much superior technology to us. We used a thing called iNet technology, which is now what NASDAQ uses. It was all part of the Internet deal from years and years ago. Our technology was pretty rubbish, but we'd still managed to build a significant market share because of our business model. During the takeover, we'd actually publicly said the rationale for this deal was they have better technology, we have market share. Combine the two businesses together makes a lot of sense. If the deal had been rejected, I went to our board and said, not terribly smart to admit now that we have inferior technology. We better go and take 4 or 5 people, lock them in a room, feed them steak once a week, and get there and build the latest technology. And that's exactly what we did. Now, the lucky break was when 85% of the staff were fired, all of them were fired. We just completed the technology, and they all walked out of the building. I'd already left. They walked into the pub next door, and I said, guess what, guys? You've all got a job. And all I want you to do now is I will pay for you to go and do what you've just done, but with different coding. And if you do something the second time round in technology, you do it without the mistakes, you do it more efficiently, and you do it cheaper and faster. And we'd already gone to lawyers. We had a lawyer back us very kindly, and we checked on the intellectual property because we knew, being an American organization, the next thing is we could end up with a lawsuit. We made absolutely certain there was no intellectual property theft in any way. In fact, we wrote it in a different language to make it. But so we lucked out by getting technology. Very, very hard when you go back to this question of somebody else coming in here to build a technology, to have a group of people who understand the exchange industry backwards, who have a different business model. Because somebody wants to come in and compete here, Chi-X or CBOE have maker-taker model, the London Stock Exchange has the national exchange status, we have the subscription model. Somebody else comes in here, they've got to do something different. People don't want to connect to more systems. They don't want more fragmentation. And what we think will happen in the end, rather arrogantly, because we believe this is the model, yes, I don't believe the other exchanges will immediately cut off the ban on the other people trading proprietary. But I do believe one day they'll move to a subscription because they won't have a choice. The world is moving in that direction. And that's painful for these guys because the problem is for people like us, when you're growing a subscription, we've copied somebody like Sky or Vodafone. You know, we bring in new order types, you charge more money for it. Sky, I happen to like racing. I pay for the racing TV. You know, I pay a premium to have that. You keep on paying premiums for all the things you want. Vodafone in your phone, if you want more message, you have to pay a premium. I want to get Spotify and I want to have 5 people in the family with Spotify, I have to pay a premium. So these subscription models are available. You don't cap out your revenue. You just have to be innovative and creative to get more revenue. Okay, so we set up the business, we brought in this rule. You'll see, if you've been on slide 10, you'll suddenly see in slide 9, what's happened to our market share. We have this liquidity, and I'll cover that in a second, but actually the amount of market share has grown substantially. Now, we floated the company in June last year, and a lot of people came and said, Alasdair, why on earth are you floating now? Why would you do that? You're not a profitable business at this point. It's early in the cycle. And what we actually wanted out of the float wasn't about raising money. We didn't raise a great deal. Actually, we raised £12 million of new money. And we could have got that at any point in time. The business was growing. We didn't need to float. What we did do, though, was with the best marketing trick we've ever had, which is, of course, once you've built this model, once you've actually got liquidity in there, what you want to do is people to know about it. And I think it's best summed up by the very first asset manager that Jonathan and I saw, who said exactly the same thing to me as I've just said to you, which is, why are you floating? Why are you doing it now? I said to him, have you ever heard of Aquis before this meeting? And he went, nope. So given the facts that I've shown you about toxicity and the depth of liquidity and the requirements of best execution in MiFID II, which is now all sufficient steps, it's a very high barrier, and you're a firm that's now responsible for best execution. So what are you going to do after this meeting? He said, well, I'm going to talk to my traders. I said, yeah. And what are your traders going to do? Well, they're going to talk to their brokers. Right. And his eyes lit up and he went, oh, so you're going to go and meet 40 different asset managers who are all going to talk to their brokers, who are all going to talk about Aquis, and are all going to question as to whether they're getting best execution. And it is no coincidence. We had set the target we were 2% market share when we floated, and we anticipated being at 3% market share by the end of the year. Well, you can see from here, we hit 4% market share. We've even had a couple of days this year where we've hit above 5% market share, and market share is growing. That isn't an accident. That is as a result of the fact that more and more people are becoming aware. And best execution is important because in the past, he rather sort of childishly says it was a try my best execution. There wasn't any real rules. People sort of had known people, said, oh, I'll go off there. And, oh, this person does a lot of market share, we'll give it to them. The extraordinary thing with best execution is it's very clear in MiFID II what you have to do. Price is absolutely essential. You've got to trade on the best price. You can't trade on a worse price. Depth of liquidity is essential. Speed, how quickly can you execute, is essential. Cost is essential. And the fifth thing is likelihood of execution. Well, when it goes to price, for 90-something% of the time, we are equal to or at the best price. In depth of liquidity, and I'll show you here, we're probably the second best provider of liquidity in depth of any other market there is in Europe. Cost, I guarantee you the subscription model at all levels of the subscription is cheaper than anything else, and in sometimes 10 times, even 20 times cheaper than others. When it looks at speed, the irony of it is we built a platform that actually does a round trip in 17 microseconds consistently, 99.99% of the time. That's the fastest platform. The irony, of course, is we ban the people who benefit from speed. But it is important because we actually sell the platform, and that's another business line. We have a technology business and we sell it to new asset classes. So performance is very important. It's this awful thing that irritates the hell out of Jonathan and I, which is likelihood of execution. Now, the likelihood of execution is this thing that's written in MiFID II and is about, what are really the chances I'm going to execute on Aquis? And the proxy for that the market uses is market share. Now that is an awful proxy, and I'll give you the example. When you get up in the morning, you do not look at the previous 1 month's weather reports to decide whether you take an umbrella or you put on sunglasses. Funnily enough, you look out the window and you look at the current conditions. And if you find out there dark clouds, you probably take an umbrella with you. So these smart order routers that the banks have, instead of actually looking at current market conditions and looking at the spread and they're looking at the depth of liquidity, for their likelihood of execution, they look at the 1 month's previous market share, which is ludicrous because it actually doesn't tell you at all whether you're going to trade Vodafone or not. Actually, if Aquis has the tightest spread and is the biggest liquidity, you probably want to go to Aquis, but they'll still send orders out in their smart order router to historical places. That is changing.
So I've lost you there. Who will?
The banks who operate these smart order routers. So you send your order to a bank or a broker. The broker then puts it into their smart order router, which in many cases isn't that smart, because actually what they do is they send it off to where the market share was the biggest. They say, oh, the London Stock Exchange had the biggest market share, we'll send the order to them. Of course, without actually looking at what the real liquidity, the real toxicity, the real cost of trading, and they're actually losing the customer money. Now, the great thing about MiFID is transparency. Now, most banks and brokers hate transparency. They love opacity. The more opaque something is. And there are some great examples and analogies here. I am a very keen sports person. Jonathan is a very good sports player, as you can see, difference in body shape. I am less good, but very keen. And if you look back 30 odd years ago, the sports authorities, plenty of papers about this you can look up, but the sports authorities showed that around about 57 to 58% of the time, the home team wins. Doesn't matter which sport it is. As long as it's a team sport, the home team wins. And the sports authorities were going, well, actually, in a game which is 50-50, you ought to have it ought to be 50-50. And as a result, they decided to bring in technology and transparency. Sounds familiar with what's going on with us. Technology in the form of tennis, where you had Hawkeye, rugby, TMO, soccer, VAR, cricket, DRS. Every sport has technology and transparency. And the good old McEnroes, who used to beat the racket and scream at the umpire and get the umpire to change a decision or terrify the umpire to making a decision, even if the ball was out, can't happen. The players in every single one of these sports hated it, in the same way as the banks hate transparency today. But the regulator shouldn't care, as the way the sports authorities didn't care. Because in the end, they just said the only person that matters is the spectator. And 30 years later, it's about 52%. Because transparency has shifted the results of the advantage that a home team has, because the ball is out, the try was scored, and it doesn't matter how much you scream and shout. You can't change it because technology has shown it. And that's exactly what's happening with MiFID II. Banks are screaming and shouting and hating it and complaining, but they're bringing transparency to an industry, and it's not going to go away. And that's why I think Libram wrote in their original report on us is, Aquis is a MiFID play. Because the more transparency you get on the market, the greater it is for the subscription model, which is the ultimate transparent model. One of the asset managers, big asset manager in Europe, came to us on the first week. So to explain the model, really interesting. He said, I just need to get my head around this. Are you telling me that the maximum subscription a bank can pay is £50,000 a month? Yeah. So that's £600,000 a year. Yeah. So for £600,000 a year, if I give all of my business to one bank, I'm not, but in theory, if I gave all my business to one bank, I could maybe be 10% of them, and I probably will never get to 10%. Are you telling me that 10% of that 600,000 is what it costs the bank to trade all my equities, get all the data, and have all the connectivity? That's £60,000. I said, yeah, that's the model. So, but I'm writing a check for 20 million today. Yeah, that's why for Spotify, for $10 a month, you get 30 million songs. That is the power of subscription.
What is the scope of your market share in relation to the scope of MiFID? You're basically covering the same geographical area.
Well, MiFID covers multiple asset classes. Actually, the introduction of MiFID II moves from MiFID I, which was purely equities, now into derivatives, bonds, etc. One of the things that we find very attractive in Aquis is we built this to be multi-asset class. So the scope of MiFID across other asset classes actually helps us. Although today we are purely in equities, we sell our technology into different asset classes. We've sold it to a crypto exchange. We've sold it to there's a company called Acanova, which is the first Lloyd's reinsurance exchange, where we are the providers of the technology. We sold it to a competitor of the Johannesburg Stock Exchange. We've sold it to a bond exchange that does infrastructure.
So that's interesting, because that's then outside the scope of MiFID II at that point.
For some of them, yes. But for some of the other things, you think of every single exchange today that has been successful in multi-asset classes has actually purchased it. Nobody's grown into
Just geographically within equities, are we talking European equities as defined by...
Today that's European equities. So for us, it's 14 markets and 1,600 stocks. but we can actually extend the stocks quite easily. There's no marginal cost, so the marginal cost is zero to extend the stocks.
And your performance across these exchanges, looking at slide 11, seems to be pretty similar. I mean,
It's very consistent. And that's because the banks and brokers will look at all the markets in a similar fashion. Although they should be more sophisticated, they will tend to operate on a very consistent basis across the markets. You will see certain fluctuations. So Switzerland is a very strong market for us. But typically, yes, it will be consistent. And you'll see with the competitors that the national exchanges are often around about 60% of the market. And then Chi-X has got about 20, and we have around about 5% now.
And the purpose of slide 11 is to show people the growth opportunity, because we're often asked by investors, do you think you can make this 10% market share? And you go, but actually, as you'll see here, the top line here was what it was in August. The bottom graph underneath is actually where it was during the last quarter. You already see that we are somewhere between 15 and 20% of all the available liquidity at the best price. Not just the available liquidity where the regulation says you have to trade. So that is the best price. So can we get to 10%? Absolutely, we can get to 10%.
And given that your subscription model means that your customers can buy more and can use more and more for the same price, are there any limitations on your hardware, your systems, which would mean that you would have to run out?
As we run today, on the maximum day, we used about just under 4% capacity of our system. So does that mean do we need to buy more servers? Yes, we do. We'll continually update and upgrade to the latest technologies, the latest switches, cards, et cetera, So there's always some form of investment, but there's no material investment. There's not a complete restructuring. The model, the way it's built is very modular. So, if we do get to higher capacities, then we simply add more servers, and it doesn't change anything as far as performance is concerned. What I would say is, at this point in time, we have 100% uptime. We've been going for 5 and a bit years, not a second of outage. It's the same team. The head of infrastructure was the same person who ran it at Chi-X with us. We did have some outage there, but I think we had the best track record of any exchange in the world. So we've got a team that we're very, very careful, and we try to mitigate all risk. And I say try because you can never guarantee. The single point of failure is not known until you know where the single point of failure is.
Out of curiosity, the Chi-X venture had 21% market share, I think you said. And I'm wondering, if you had 21% market share, what would the revenue look like relative to the model that you were operating under Chi-X?
Well, I'm not certain that I can, particularly in front of our great analyst here, be able to tell you exactly what those numbers are going to be, but I think it's not that difficult to calculate. And I'll tell you the mechanism by which you would do it is, first of all, our top subscription price is 50,000. So £50,000 a month, that's without any of the add-ons. We have other products and things that might pay an extra 10,000 here or 5,000 for whatever. But if you take 50,000, there are 15 top banks, with which we have 14 of them connected today. They're not all using us properly, but there's 15. So you can quickly work out the maths of what that's going to be of those 15. We believe there's another 70 to 80 customers. They're not going to necessarily pay you 50,000 a month, but they are certainly going to pay you something between your 2,000 and 30,000. So you average that out. Today we have 27 customers. Once Brexit is over, I can tell you now, I promise you, the sales funnel is extremely good, because once you've got that sort of market share, and once you've got that market liquidity, you're breaking best execution rules, so people have to come and join you. So there's probably another 70 odd customers there that are going to come in. Now the great thing is you can do that maths, but our top customer today pays an equivalent rate of something like 0.07 of a basis point. And I'll say that again, it's not 0.7, but 0.07 of a basis point for execution. And we reckon that they're giving us 4 to 5% of their business. If they were to give us 20% of their business, that rate would get to sub 0.001 of a basis point. And the great thing is, from an investor point of view, less from the client point of view, is that at that difference of price compared to anybody else out there, you can do what Sky, Vodafone, and every other subscription does, is your price elasticity is fantastic. You can move these prices up because you will still be the cheapest by such a considerable margin. But the key for us, if I look at what the key performance indicators internally are, we want to get to profitability next year. That is absolutely what we feel very comfortable, and we can improve our business model, and we think that's fully achievable. Internally, we say it's not just so much getting new customers, it's getting your customer from the 5 and 15,000 bracket into this 50,000 bracket, because that really makes a difference.
How often are you able to change prices under your contract?
We've changed it once so far. We tried to simplify it, and we actually brought the number of messages to get into 50,000 down. My guess is we will not add we don't want to keep on adding new tiers. A lot of people think we'll add new tiers. We don't want to do that. We want people to take real advantage of the Spotify effect and then change the subscription price. Of course, there's a third revenue stream, which will come in later, which is absolutely key, which is a golden nugget, which hasn't been priced yet, which is data. The thing with data is that today we charge our vendors. We don't charge customers. So if you're an outsider like a Bloomberg or an Market or whatever, and you want to take our data, then we'll charge you £2,000 a month for taking the data. And we have today 13 of them. But the real thing is, if you look at the States, I don't know how many of you are familiar with the way the pricing mechanism of the United States, but there you have a consolidated tape authority. The market share of an exchange, what happens is there's an independent authority set by the regulator who charges and sets the price of data, which is materially cheaper than Europe. And that is then distributed back to the exchanges, the platforms, dependent upon your market share. Now, today I can tell you that there is a lot of talk. I mean, a lot of very, very serious talk. It was meant to come up in MiFID II, but by the next 2 to 3 years, we are very convinced that the regulator will mandate the exchanges and the industry to provide a consolidated tape here. Almost certain it's going to happen. And that radically changes. If we go to a CTA method, it would radically change the way that we would have data here, because that would be then seen as a market share. Now, again, you can work the numbers out, but roughly 1 billion euros is the revenue streams of the exchanges on market data services. 1 billion euros in Europe. And everybody, absolutely everybody, complains about data. We want to be part of the disruptive move that changes the way that data gets charged and the way that data is priced. And we absolutely will do that. The moment our market share continues to grow, we will be pushing the prices of data down in the industry. Down for the industry means a new revenue stream for us.
What data can you actually provide? Obviously, they're working on a backward-looking method. Is there something better that you can provide in terms of data to support?
Yeah, I mean, if you look at slide 12. I mean, slide 12 is actually an interesting slide here. I mean, this is a slide we often show asset managers, which is basically slide 11, but in sort of advanced. What that is that the natural thing here is the market share in every market in Europe across the last quarter last year. So we're not talking about small amount of data. This is the whole of the quarter for each of the markets. So starting in FTSE 100 on the left, right the way out to the OBX on the right. Now, we looked at just not the national exchanges, we've looked at the competitors. So all the people like the Chi-X, the CBOE, the BATS book, the Turquoise book, etc., and us. You can see the grey one, pretty big, bigger than everybody else. That's the old Chi-X book. That's where we came from. That was the big market share they have. And you'd think that the biggest market share ought to have the biggest amount of liquidity. But if you look at the lines that go across, what you'll see is that the grey and the blue lines are really intertwined. We are the blue, and Chi-X book is the grey. And you would think that the market shares of the best liquidity available at any point in time should be pretty much the same. And we're the blue box there. We're bigger than Turquoise now in certain markets. We're even bigger than the BATS book in certain markets. But you would think that our market share should be significantly higher. Well, we have 27 customers. When I left Chi-X, they had 128.
Sorry, what's the definition of liquidity?
The liquidity is you add up the best price and the size and depth of that best price available throughout the day on every single stock for the entire quarter. So you're looking at the definition of MiFID II, which says you have to trade at the best price where it is in its depth. And if you're crossing the spread, there isn't a choice. So you would expect that's where you should go.
One concern about adding further trading facilities is, doesn't that, I mean, it seems obvious that would tend to fragment liquidity, which has been a problem generally that the more exchanges you have, assuming a fixed amount of liquidity, the less there is in each.
Right. Can I say 2 points here? The first is competition and fragmentation diametrically opposed. So if you have competition, there should be a benefit. You'll create greater fragmentation. But the assumption I would like to change in your mind is that it's a zero-sum game. It's not a zero-sum game. In the United States, it's a quarter of the turnover. We do a quarter of the turnover of the United States in equities in Europe. We have a land mass approximately the same. We have a population that's actually slightly larger, and over the last 10 to 15 years, we have GDPs that are pretty comparable, and yet we only do a quarter of the turnover. And that tells you that the structure of equity markets is poor compared to the structure in the United States. Our business here is not about the zero-sum game. It's doing what subscriptions have done to every other industry. More phone calls are made today, more movies are manufactured today, more music is listened to today, more equity trading will take place today. So it's not about actually taking market share from somebody else. We clearly need to build market share. It's about building a marketplace that actually has more liquidity. And what that does is it lowers the cost of capital to SMEs. If you're coming to the marketplace and your liquidity in secondary trading is greater, then your cost of capital is going to fall. So there is a real reason as to why an Aquis needs to be and should be supported, because it's the mechanism where we can create and lower the cost of capital at the same time, increase the liquidity available.
But it also helps with innovation. If you haven't got competition, then the incumbents are not going to innovate, they're not going to invest, and you will have seen after MiFID I the dramatic change, and you'll see further changes. And I think, or we believe that Aquis will definitely promote innovation. Not only our own, but also the competition will need to innovate to catch up.
The dilemma you've always got there, which, to go back to your point, is every week somebody comes along and says, I've just invented new sliced bread, and therefore this is the greatest invention. I think in this case we have. But I mean, I think what you actually do have to do here is be very selective, and which is why it takes a long time. These businesses don't grow quickly. And people keep on saying, well, you've got all this data, why aren't you 100% market share today? So because people don't like fragmentation. People take time to join you. People are wary. And actually that's one of the great things about the city, is that it self-regulates itself between those businesses are really going to grow. So therefore, there is a reason why it will take you a long time to actually get to that saturation point.
What are your criteria for covering a particular instrument? What do you have and what do you not have on your...
Well, we started off with the major index in each market, and then we moved to the secondary index in each market, and then we actually are gradually going down the chain. In the early days, I went to see a very large private client, private broker, stockbroker. And when I talked about the concept of, wouldn't you love it that your clients would be able to trade as much as they liked each month for X pounds per month, settling, clearing, trading, all risks. It's like, if somebody could turn around to me and say, for £100 a month, Alasdair, you can trade what you like. Doesn't matter, any market across. I'll clear, settle, everything else. You just carry on trading. You'd bite your hand off. You would certainly increase the amount of business. Now, we're going to start that on the execution end. But when you're powerful in the execution end, you can change the clearing end. When you change the clearing end, you change the settlement end. So you can gradually build a model for the retail market. And that's what I expect. I expect in a few years' time to be on my iPhone or whatever, trade as much as I like in the same way as I can do that on almost any other thing, Spotify or whatever. And that's where I think we'll get to.
Can I just comment there, and I'm glad with the direction you've described your exchange moving in, that from the point of view of the retail investor, unlike institutions, we have no issues with current platforms for trading big cap stocks. You can trade Vodafone as a retail investor with incredible ease. Where there is an issue is with the small cap stocks, where there can be huge spreads and lousy liquidity. And we would really love our members, obviously through their brokers, to have the facility to place direct orders on the book in the type of fashion that your exchange allows. In theory, one can do this on the LSE, but the LSE, I understand, makes it so difficult for brokers that very few of them offer it.
It's music to my ears what you say, because the RSP is, and I daren't say it when I'm sitting here in Librum, obviously as supporters, you'd understand, but it is an effective monopoly in the industry without competition. And it irritates the hell out of me that I want to trade stock in a small cap and I can't get in the midpoint price. I see these spreads and they say, oh, you can't get there. And the moment you do that, the price, it's like, it drives you nuts. You need competition. You can only get competition through firms like us who are going to come out there. We will get into that space.
So you currently can't trade Aquis on your platform?
No, there's a wonderful irony on that. We've tried it, but we couldn't actually get it to happen, which sort of makes me more angry as to why we'd need to make it happen.
And it will. It's a temporary phenomenon.
Who are your customers? You've talked about banks. You've started to mention brokers. What sort of organisations?
I think we actually have a slide which mentions a lot of the banks and things in here. Page 6 has this. So, I mean, the Internet, SocGens, the Morgan Stanleys. I mean, so you've got some of the major banks there. We tried to take a selection of what I would say some mid-tiers, some major banks. As I say, 14 of the 15 top 15 players. We have 14 of them in Europe. The next stage for us is to get down to the second tier, which I think are, without being rude about those sort of organisations, but they are the Macquaries, the Librums, the SEBs, the Barda banks, the people like that. Good firms, solid firms. We want to target those. But it's more important for us to target the big firms first and get them into that sort of 30, 50,000. Then you've got the market share where they have to start trading, where the others have to come.
Could you tell us about your contingency planning for Brexit?
Yep. We've opened up an office in Paris. We are a regulated entity in Paris. We have already 12 stocks trading live in Paris, so that every single one of our customers has been able to repaper, put their contracts in place and actually test their systems. So in the case of a hard Brexit, we would be perfectly capable of trading the stocks. In fact, we went one stage further, which is we were the only firm that actually could trade all stocks in both centres. Technically, that's very, very difficult. And in fact, the regulator went round and gave our competitors until the end of the year, and they were a little bit shocked when we turned around and said, we can start it on Monday. And there was quite a bit of publicity on that, which allowed us. There's lots of technical reasons. It's not easy to have a single ISIN traded on 2 platforms in 2 jurisdictions.
On regulatory capital, can you explain the reasons why you need it? I presume you're just earning fees. You're not carrying on your balance sheet any exposure.
No.
So maybe you could just expand why.
Jonathan, that's definitely...
So a regulated MTF, which is what we are, as part of the regulation, you have to have a minimum of 730,000 euros of capital. That is part of the qualification. But in actual fact, the reg cap is a mixture of risk assessment and expenses. So they expect you to cover 3 months' expenses. And as our costs have gone up as we've invested in the company, so that reg cap has gone up a bit. But also we go through a risk assessment process. So what happens if the data center got knocked out, or what happens if we lost some clients? And we'll do a risk assessment, and that adds to the reg cap. So the reg cap for us is around about 2 million. It's not huge, but it is important, and the regulator expects you to have that to make sure there's business continuity.
But if you went to, say, 40 million of revenues, and I presume you've got a lot of operational gearing in your model, are we going to be looking at the costs as the proxy for...
No, the reg cap doesn't change a huge amount. Yes, even at Chi-X, I can tell you the reg cap that we had there was less than 3 million at the time. So it's definitely, this business is fabulously scalable.
Can you talk us through a little bit the time it takes someone to sign up? Then when they sign up, do you invoice them immediately and they have to pay you before they start using the service, or how does it work?
No, we've been remarkably generous, and in hindsight a huge mistake really, but we're very kind to our customers, which is you sign up, you start trading. The moment you start trading one aggressive trade, then you've got into the £2,000 bracket. So you're already paying us £2,000. We don't invoice you until the end of the month, and we will tell you, and you can look up each day, what your average message count is. If you then suddenly go into the 5,000 tier or the 15,000 tier, you'll be invoiced. and then you have to pay us in reverse. If you then drop the following month, so one month you're 30,000, the next month you're on 15,000, unlike Vodafone, we don't hold you to a 1-year contract.
And what's the settlement period? If they're billed at the end of the month, how long do they have to pay the invoice?
30 days.
30 days.
It's standard, and most of them do.
And in terms of technical implementation with a new client, what's that like?
Pretty simple. It depends. I mean, there's two ways to connect to us. You can go through FIX. I don't know, FIX protocol, which is a pretty standard protocol in our industry, and it's we can do all sorts of versions, go into the details, whether it's 5 or 4.2 or whatever. There's what we call Aquis Trading Protocol, which is a binary protocol. The binary protocol is slightly faster, so you'll find market makers and other people wanting to use that, but it's only about 5 microseconds, 70 microseconds on binary and about 22, 24 on the FIX. What tends to happen, though, is people will go through third-party systems. So most of what I call the smaller brokers will end up using Fidessa, UL Link, Bloomberg, somebody else like that, all of whom will connect to us.
The business is basically three revenue lines. So I think we've run through. We have the exchange, and currently there's 14 markets, 1,600 stocks, and we will continue to invest and to expand that over the next few years. Very dependent on the levels of trading for our members, but some very encouraging progress over the last 9 months since we IPO'd. The technology licensing is the second line, and that has been progressing well. We've seem to have hit a good sweet spot in terms of alternative assets. As Alasdair said, the reinsurance market, the crypto market, and this is an area where, first of all, it's very interesting in terms of the business development, but it gives us great optionality because at the moment we are providing licensing, but in the future we can actually initiate that type of business. So we could go into a joint venture type arrangement if we wanted to, if we saw the right opportunity. And the third business line, which will probably start to impact more in about a couple of years' time, is the data when we start to see changes in the regulation. All these things, I think, point to increased revenue, increased profile, and steady progress in terms of how the business will evolve.
I quite like our little marketing thing, which explains the company. We're one company, 2 identities, and multiple products. Because I think it's quite often quite hard to explain what you are when you're trying to do so many things. When people sort of say, "What is the brand?" Well, Aquis, we are fundamentally different to any other financial services company because of that subscription model. And although it was extremely difficult for the first 3 years, once you get momentum in these critical mass games, it took Blockbuster 10 years to get beaten by Netflix. It may take us 10 years to get to where we want to be, but we will get there because that model works, and it has proven to work in every other industry.
Tremendous. Thank you.
Very much.